Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Invesco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Invesco is a real estate investment trust. The trust purchases and manages residential and commercial mortgage-backed securities and mortgage loans. A mortgage-backed security is an investment similar to a bond, except it's backed by a bundle of mortgage loans. Investors in an MBS receive periodic interest payments similar to bond coupon payments. Let's say, for example, there's a bond that's backed by 1,000 mortgage loans. Let's pretend 10 homeowners, 10 of those mortgage loans defaulted. Even if that happened, the bondholders will still get 100% of their principal and interest payments. Let's say 200 people default on their loan. That means 20% of the loans went into default. Then the junior bondholders may suffer losses. The junior bondholders are lower in the capital structure and receive a higher interest rate since they're taking the most risk, because they're first in line when there's defaults, when there's losses. The senior bondholders are higher in the capital structure and receive a lower interest rate. But if a lot of people default, say 300 or 400 people default on their loan, and the junior bondholders are wiped out, then the senior bondholders may start to suffer losses. This happened in 2007-2008 during the Great Recession. The stock price for Invesco and other mortgage REITs fell about 80% in March 2020 during the COVID pandemic. Invesco is headquartered in Atlanta, Georgia, and was founded in 2008. The ticker trades on the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 446 million market cap. They're trading at $11 a share, and they have 41 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do report positive free cash flow each year. I'll show you their statement of cash flows in a little bit so you can get more detail. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was positive in 2019, negative after that. Net income is not a good indicator when looking at this type of company. Same thing with revenue. It's not the best indicator. Price to book is. Revenue for this company is the interest spread they receive, the interest on their investments. And that was highest in 2019, down to $195 million in 2022. This is the company's income statement from their 10K. This shows us 2020, 2021, and 2022. Their total interest income for 2022 was $195 million. That was $193 million on mortgage-backed securities, $1.9 million on commercial loans. Our commercial loan is just a loan to a business, because all the loans inside the mortgage-backed security are probably not too big, but commercial loans tend to be much bigger. In order for the company to buy these investments to get these interest payments, they need to take loans themselves. The way they get money is through repo agreements. Repo agreements are short-term borrowings for people who buy government securities. So repo agreements are short-term loans, usually a few days. They're pretty safe investments because the collateral backing the repo agreements are these mortgage-backed securities. The interest they paid on these repo agreements in 2022 was $52 million. So their profit or their interest income is the income they received, $195 million minus the $52 million, so it's $143 million. And depending on which way interest rates move, they can take a lot of losses, but these are unrealized losses. They're not actual cash losses. They had $1 billion of paper losses in 2022. That's assuming they sell the securities, but they don't have to sell them. They can just hold them until maturity and hope interest rates go back the other direction. And they also use derivative contracts to hedge against these losses. So even though they had $1 billion of paper losses, they hedged $559 million. So on other income and expenses, they had a loss of $521 million. In 2020, they had a loss of $1.8 billion. And then, of course, Invesco charges fees. That was $17 million. And then general and administrative expenses, probably payroll, $8.4 million. So the net loss for 2022 is $400 million. They paid out $28 million of dividends to shareholders. In 2021, it was $38 million. In 2020, it was $44 million. They had a gain of $14 million on the repurchase of preferred stock. Their loss per share is $12.21. Last year was $5. In 2020 was $99. So it doesn't look so great, their income statement, right? It looks like they've done a lot of dilution. They doubled their shares outstanding from 17 million to 34 million. Here's the assets and liabilities section of the balance sheet, 2021 and 2022. They had $8 billion of mortgage-backed securities in 2021. Now it's about $5 billion. Cash of $175 million. Restricted cash of $100 million. Restricted cash is cash that's set aside for a specific purpose. So total assets is $5 billion. And below that is their liability section of their balance sheet. The repo agreements are like loans. They have $4.2 billion of repo agreements. Last year it was $7 billion. You should look at their balance sheet and make sure the mortgage-backed security investments, the value of those are higher than the repo agreements, which they are. If they were lower, then they would be underwater. And they don't have too much else in liabilities. It's pretty small relative to this big $4.2 billion. And this is the equity section of their balance sheet. This shows us their preferred stock they issued. They raised $110 million from Series B preferred stock. That pays a high interest, 7.75%. Series C, they raised $189 million. The amount they raised in common stock is additional paid in capital. That's $3.9 billion. They have a loss in retained earnings of $3.4 billion. Retained earnings is the sum of all your prior net incomes minus the sum of the dividends you paid out. So they have $800 million in equity, down from $1.4 billion in 2021. The statement of cash flows is broken out into three sections: operating, investing, and financing. This is the operating section. This gives us a better indicator of how the company's doing than the income statement, because you want to follow the cash. Even though in 2020 they had a net loss of $1.7 billion, they generated $170 million of cash flow. So every year they generate positive cash flow. To calculate operating cash flow, you start with your net loss of $400 million. They pass through a $470 million gain on their income statement. That's a non-cash item, so we have to subtract that out here. It's like if you buy stock for $10,000 and the stock price goes up to $30,000, you have a paper gain of $20,000. You didn't make $20,000. You still may report it on your personal balance sheet as a gain, but it's a non-cash item. Same thing if you lose money on a stock, you didn't actually lose any cash, unless of course you sell the stock. Remember they had a $1 billion loss on the income statement? That's also a non-cash item, so we have to add it back here. The reason they passed through a $1 billion loss was because interest rates went up a lot, and the value of bonds goes down when interest rates goes up. This top part is the investing section on the statement of cash flows. This middle part is their financing section. So in their investing section, it shows they purchased $26 billion of mortgage-backed securities. They also purchased $500 million of treasury securities. They sold $27 billion of mortgage-backed securities also in 2022. So in their investing section, they had a cash inflow of $2 billion. In 2020 was a cash inflow of $11.5 billion. Remember I said earlier, repo agreements are short term, so that's why you see a positive and negative. In the financing section, there was a cash inflow of $67 billion from repo agreements and a cash outflow of $70 billion. It's not like long-term debt where you'll see a cash inflow 1 year and then maybe 10 years later you'll see a cash outflow from that debt, when of course they pay it back. And I use the highest WACC on Finbox, 13%, the weighted average cost of capital. The higher the WACC, the lower my valuation will be, and the lower the WACC, the higher my valuation will be. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.3 billion. We divide that by 41 million shares. And we get a calculated stock price of $30. They're trading at $11, so they're trading at a 64% discount. It's a strong buy according to the model. The way I forecasted their future revenue, I just grew their 2022 revenue by 10%, and I did that each year for the next few years. That's how I got their future revenue estimates. And they convert on average 61% of their revenue into free cash flow. So I multiplied their future revenue estimates by 61%. That's how I got their future free cash flows. A DCF is probably not the best way to value this type of company, but I was just curious what I'd come up with. It's really hard to value these type of companies or banks or insurance companies. 3 analysts priced this stock and the average price target is $12.33. The low is $12, the high is $12.50. Another 3 analysts priced this stock and the average price target is $12.67. This is where the stock has been trading the last 5 years. Like most mortgage REITs, the stock really crashed when COVID hit. And this stock hasn't recovered, it's just gotten worse. They did a big reverse stock split to get the price over $1. It looks like it's pretty much flat since that point. Usually a reverse stock split, the stock price goes down even more. It's rough days for owning this stock, but you get a massive dividend. At one point, the dividend yield was over 50%. And I calculate their current yield at 15%. They were paying up to $5 a share at the end of 2019, but they cut it pretty drastically when the stock crashed. But they still pay a dividend payment even though the company seems to be struggling, which they could afford. It's only 34% of their free cash flow. And you can't really look at the payout ratio because remember, when we look at the income statement, it's really skewed by the large unrealized losses and derivatives. This is the company's dividend yield the past 10 years. You see it was about 60% when the stock crashed. But it looks like the yield is projected to be about 15-16% by 2025, which is still a crazy high yield. They have a beta of 1.55, so the stock is a little bit volatile. It moves 1.5 times the market. It's down 46% in the past 52 weeks, while the S&P is down 7%. 52-week low is 10, the high is 20. And the stock is on a downtrend, trading below its 50-day and 200-day moving average. About 1 million shares are traded each day on this stock. Of the 41 million shares outstanding, 39 million are on float. Half the shares are held by institutions. Has a pretty high short percentage. About 12% of the shares on float are shorted. They've done one stock split. It was a reverse stock split, a 1 for 10 in 2022. When a company does a reverse stock split, it's usually to get the stock price above $1 so they don't get delisted. It's a sign of a company in distress. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have had $17,000 right before COVID. But if you still held on, you'd be at $1,700 today. That's an 83% total loss. In the past 12 months, there's been 3 insider buys, 1 sell. 53% of the company is held by the general public, 47% by institutions, and 0.2% by insiders. Their biggest shareholders, BlackRock at 15%, then Vanguard, State Street, Geode, Murray Asset, Renaissance, Susquehanna, Citadel, Northern Trust, and BNY Mellon. There are 40 publicly traded REIT mortgage companies, and they rank 26th in market cap at $446 million. The average is $1.2 billion. Look how high these dividend yields are, just crazy high. 97% of their investments are in agency RMBS. When you hear the word agency RMBS, the agency is Ginnie Mae, Fannie Mae, or Freddie Mac. Ginnie Mae bonds are backed by the US government, so they're pretty much risk-free. Fannie and Freddie used to be backed by the US government, but now they're publicly traded companies. But they're still considered quasi-government. They're pretty safe investments. 2% of their portfolio are agency collateralized mortgage obligations, and 1% credit portfolio. This is one of their PowerPoint slides from their fourth quarter earnings release. We'll go through some more slides. But they had net income of 84 cents in the fourth quarter, so it's positive, that's good. Book value per share, which is an important number to look at, that's about 13. 65-cent dividend, and it's a 5% economic return. Since interest rates are going up, they increased their yield 99 basis points, which is pretty much 1%. It looks like they did some dilution in the fourth quarter, 43 million of common stock under the at-the-market program. At-the-market is just issuing common stock at the current market price. Look how much interest rates have gone up. Money market rates were pretty much 0 at the end of 2021. Then they were 1% 4 months later in April 2022. 2% 3 months after that in July 2022. 2 months later in September 2022, it jumped up to 3%. The following month in October, 4%. And at the end of 2022, it's sitting around 4.5%. The rise in interest rates really affected companies who hold long-term fixed rate assets. And that's a big reason Silicon Valley Bank went bankrupt. because the value of these bonds, these assets they hold, dropped significantly, so they sold them at a loss. Then they had to dilute shareholders to shore up their balance sheet, which subsequently scared depositors who took their money out of the bank, forcing a bank run and the company to go into receivership. Look how low their coupons were in 2021, 2.5%, 3%. Now this green bar, 2022, look how high it is at 5.5% and 5% and 4.5%. They increased their agency RMBS investment portfolio by $4.7 billion in the fourth quarter of 2022. So they increased the yield they earn because they rotated out $1.2 billion of lower coupon investments and they transferred in higher coupon investments, which sounds great, but they don't mention the loss they took on the repo agreements. Their CPR, cardiopulmonary resuscitation, is 5.4%. So that means at their office, if somebody's choking on their lunch, they could only save 5% of those people from choking, from imminent death. 1 out of 20 people. Obviously, I'm joking. CPR is conditional prepayment rate. This is the percent of the mortgage pool that will be paid off prior to its schedule. Why would a loan get paid off prematurely? Say you bought a home and you took out a mortgage and the interest rate was 6%. If the interest rates go down to 5%, 4%, you're going to refinance. That's a reason you would prepay your loan. You're just swapping it out for another loan. You generally want this number to be fairly low because if a lot of people are going to be swapping out their loans, that means the company could start to take some losses. The average interest rate the homeowners pay in their portfolio is 5.25%. If it was really high, you would see lots of people refinancing. And if it was really low, then this company would be losing a lot of money. Here's a breakdown of their CMO investments, collateralized mortgage obligation. 81% CMBS non-agency, 18% RMBS non-agency, and 1% joint ventures. CMOs are a pretty small part of their entire portfolio. I worked for many years in non-agency RMBS and CMBS. These are bonds investment banks issue, like Goldman Sachs, JP Morgan. The loans in these portfolios don't qualify in agency bonds, in the Ginnie Mae or Fannie Mae bonds. So they tend to be higher interest rates. That's why it's a pretty small percentage of their portfolio. And they are a little more risky because they're not backed by the government. So to summarize, I have them trading at a 64% discount, but it is a hard company to value. They're still around, which I guess is a good thing, but their market cap has come down so much. So it's definitely a risky investment. But if you did buy the stock when it crashed, you probably got all your money back and then some in dividend payments. So I guess those people are happy. But like I showed you earlier, if you bought the stock 10 years ago and still holding, you'd be down over 80%, even with the dividend payments. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.